Good morning, everyone. I am Kenny Hart Castellanes, a BSS Social Studies 2. So today, let's learn about the confirm and contrast the different theories of development.
1. Market socialism.
Ownership matters. It gives people a say in the things they care about. Being an owner in a business, for example, gives people motivation and a stake in its success. But over the last 30 years, the number of people who have control over the businesses that shape our lives has become smaller, not larger. It's no surprise that when you ask them, people say they have no influence in their workplace, over businesses, and over the economy as a whole. Cooperatives, however, offer a solution. From the outside, they may look like any other business, but inside they are very different. They're owned and controlled together by the people closest to the business: employees, customers, residents, suppliers, not distant shareholders. They have an equal say in how the business is run, and they even decide what to do with the profits. And cooperatives work. There are nearly 7,000 independent co-ops in the UK. They're found in every sector, from high street retailers to farmer-controlled businesses, cooperative pubs and credit unions. Some of our most famous brands come from cooperatives, from champagne and parmesan to Lurpak butter and bird's eye peas. Even Barcelona Football Club is a co-op owned by its fans. Co-ops contribute £37 billion each year to the British economy and boost UK productivity, innovation and entrepreneurship. And they work for the 15 million members who together own the UK's co-ops. Cooperatives give people, in fact all of us, more control over the things that matter.
2. Supply and demand.
Get your hands on that new video game system. What would you do if the prices at your favorite pizza shop increased? Every day, people ask questions like these relating to the concepts of supply and demand. Demand is the desire consumers have for a good or service. The more people who want a good or service, the higher the demand for it. Supply is the total amount of a good or service available for consumption. The higher the amount of a good or service produced and made available to consumers, the larger the supply of it will be. Supply and demand have a big impact on the prices of products and services. Consider what happens with bananas. Now, there are few bananas on the shelves, but many people are waiting to purchase them. The demand for bananas is higher than the supply of bananas, because there are more people wanting them than there are bananas available at the market. Knowing this, the banana producer may increase the price of the bananas because they know that with the higher demand, many consumers are willing to pay more to get what they want. Some consumers will decide to leave without purchasing bananas because they aren't willing to pay the higher price. What would happen if we added another producer to the situation so that there are two banana sellers? The demand for bananas would be lower than the supply because there would be more bananas available than consumers want. The banana producers may decrease the price of the bananas to entice more consumers to buy their product, thus increasing the demand for bananas. Understanding supply and demand is key to understanding our own purchasing behavior, as well as the way business works.
3. Laissez-faire capitalism.
A laissez-faire economy strongly opposes government intervention in business. French for leave alone, laissez-faire became an economic theory in the 18th century. Supporters of laissez-faire oppose minimum wages, duties, and other trade restrictions. They believe that businesses free from government regulations will flourish. Laissez-faire theories were influential in the United States Industrial Revolution. The works of classical economists like Adam Smith influence laissez-faire's applications today. Smith argued that humans decisions will serve their own interests first and that societal benefits will follow. While laissez-faire remains one of capitalism's guiding principles, critics claim that it can lead to poverty and economic imbalances. Unfortunate examples are the unsafe work conditions and large wealth gaps that appeared in the U.S. during its Industrial Revolution. The U.S. implemented policies to protect workers from hazardous conditions and consumers from unfair business practices during the Depression of the 1930s. It's important to note that these policies were not intended to interfere with business practices and competition.
4. Moral hazard theory.
Moral hazards. Moral hazard is a concept in economics and risk management that describes how an individual or business's behavior may change once they become insured against the risk of a certain action. It occurs when people take unnecessary risks because they know they will not bear the full consequences of their actions. In other words, moral hazard exists when someone has little incentive to behave responsibly due to the assurance of protection against any losses caused by their actions. For example, if you have not insured your house from any future damages, it implies that a loss will be completely borne by you at the time of a mishappening like fire or burglary. Hence, you will show extra care and attentiveness. You will install high-tech burglar alarms and hire watchmen to avoid any unforeseen event. But if your house is insured for its full value, then if anything happens, you do not really lose anything. Therefore, you have less incentive to protect against any mishappening. In this case, the insurance firm bears the losses and the problem of moral hazard arises. Similarly, banks and lenders may be more willing to provide loans if they know that the government or other entity will provide a safety net for them if the loan goes bad. Moral hazards are also called principal-agent problem. In the insurance context, the insurance company is the principal, and the policyholder is the agent. Situations like moral hazards are bad for the economy as it can lead to market failures. Thus, there is a need to follow steps to mitigate the risks of moral hazards. So, what can a principal do to face the potential moral hazards? One possible solution could be an improved monitoring of agents' action by the principal, but the marginal benefit of this improved monitoring should be weighted against the marginal costs associated with it. Regulations should be introduced by government, and some basic requirement guidelines should be introduced by insurance companies, which clearly specify the actions to be taken to reduce moral hazards. Insurance deductibles and co-payments should be imposed by the insurance companies. Such provisions in insurance contracts that impose costs on the policyholders for behaving in a risky manner will reduce their willingness of taking any risk.
5. Tragedy of the commons.
Have you ever wondered how your favorite everyday items impact the environment? Perhaps they have a positive effect, which is... Have you ever wondered how your favorite everyday items impact the environment? Perhaps they have a positive effect, which is why you buy them. Now imagine that's not the case. What if your favorite items threaten the ecosystem? Or worse, what if consuming and using them threatens their very existence? This scenario describes what's known as the tragedy of the commons, an economic theory conceptualized in 1833 by writer William Forster Lloyd. The term was later used as the title of an influential essay by ecologist Garrett Hardin in a 1968 issue of the journal Science. The tragedy of the commons posits that individuals with access to a shared resource, also called a common, act in their own self-interest. In doing so, they ultimately exhaust that resource. When facing the inevitable depletion of a common or good, they typically act with their short-term best interest in mind. They may have a use-it-or-lose-it mentality and think, I better get my share while I still can. Despite this, individuals can be motivated to act for the greater good. For example, consider a town in the midst of a drought that regulates the days and times residents are permitted to water their lawns. To avoid standing out and having the sole pristine lawn in the community, every resident abides by the regulations and doesn't use more water than allowed. This example illustrates how a moral incentive can prompt individuals to consider the broader impact of their decisions and act in the interest of others. Money can be a powerful motivator too. For instance, bringing reusable bags bags to the grocery store instead of paying for paper or plastic ones. The tragedy of the commons shows that without regulation or transparency when it comes to choices and actions associated with goods, individuals have little incentive to refrain from taking too much. But it doesn't have to be that way. By becoming sustainably minded, individuals can be more aware of the long-term impacts of their short-term actions and make decisions that benefit both people and the planet.